The stock market is gambling. You place bets, through buying stocks long, shorting them, or purchasing options contracts. We consider gambling a vice, but not investing. And I think this is something that anyone that's investing needs to think about and understand, because investing can become gambling very easily. Now, why do we look at, gambling and investing in two different lights? Well, because we've all heard the phrase, I think, that, the house always wins when it comes to casinos and when it comes to gambling. And of course, this is referencing that, how casino games always have odds so that the casino will win more on average, meaning that you lose more, given a long enough timeline. So regardless of whatever short periods where you may win, given a long enough time frame, the expected value is that the casino is going to win more times than the, person playing the game. And, it's contrastly common knowledge that the stock market goes up over time and therefore is a fairly safe bet long-term investment. This is the perspective that most people have. Now, the issue with this mindset is that we have to remember that all investments come with risk and that there are no sure things, right? We accept that casino games are all about probabilities, and we, with the exception of games like blackjack, we have no tangible actions, generally speaking, to change them. Like, the odds are the odds. At the end of the day, there's very little that we can do about them. Whereas with stocks, we can very easily get overconfident and fall prey to the Dunning-Kruger effect. So if you're not familiar, essentially this is a term that's used to describe someone who doesn't know enough about a subject but has a lot of confidence, i.e. they have, a low level of ability, but they really overestimate that ability. This is something that's really easy to do in stocks. This is why in my opinion, you see so many people that are selling courses on like day trading and, statistically unsuccessful, ventures when it comes to investing. And this is not just with investing. Dunning-Kruger, it's very common in our society, but, as more information is readily available on the internet, we're going to have people that think they're experts on things that they don't know deeply enough. And, that can hurt you as an investor. So you got to make sure you keep yourself in check. And this seems to, be even more increasingly common with more democratized investing platforms, like Robinhood, Webull, links for both in the description if you're interested in signing up for those and don't have them. And, you'll see young they're disrupting the market because they have lower costs, no commission fees. And that's getting a lot of people that are, normies involved in something. And we need to make sure that they have a full understanding of what it is they're getting involved in, because this is not, something to trifle with. This is serious long-term implications. And young investors, it seems, are very quick to get impatient with index funds, just like all of us. This is not just a young thing. This is the access that we have makes it more pronounced. But people will generally get pretty impatient when it comes to index funds with, just a steady 8% annual growth, and what they'll do is they tend to jump to things like options, day trading, penny stocks, because they see, there's free real estate. And this is a really important thing because, when we play a game of blackjack, right, we may bet, $20, right? And we just recognize that, okay, it's lost money, right? We don't really need to worry about it, but it was fun, whatever. It's $20. Who cares? Whereas with stocks, this can easily turn into losing thousands, just because you're breaking the basic rules of investing. And that's something we need to keep in mind. So I want to go over some rules that I have for, just general rules of thumb. Again, I'm not a financial advisor. I'm a guy who is really passionate about finance and, wants people to better understand it. So keep that in mind and take this with a grain of salt. But here are some just general rules that I have for, avoiding stock gambling. Number one is first and foremost, like always, no matter whether it's any type, no matter what the investment is, if you don't understand it, don't invest in it, right? So if you can't explain what the ETF company commodity is or does, you should not be investing in it. If you, and I mean, explain it simply to a person that has never understood, like that has never, heard of it before. If you can't do that, you do not understand it. If you don't know what the financials are, right? If you don't know what the price to earnings ratio is, if you don't know what the book value, ratio is, if you don't know what the dividend percent payout ratio, if you're a dividend investor is, you should not be investing in that stock. You do not understand it. And this is most likely going to cause you to, pull the trigger when you don't need to, pull out of a stock and lose money. It's not, or make riskier investments. This is not a good strategy long-term. And if you haven't done a lot of investing, and this is my opinion, but if you haven't done a lot of investing in stocks, long or short, you probably should not be trading options, because it's just too risky, in my opinion, for most people. Once you've been investing for a couple years, then maybe you have the, knowledge and the cojones, essentially, to do what you need to when you need to. Hold when when it looks bad, and buy when it looks, worse. But yeah, in general, you need to make sure you fully understand it. And also, if you don't understand shorting, then you probably don't understand options. It's much more complicated, in my opinion. And then with that, number 2 is remove emotion, right? Hype is not a reason to buy a stock. I don't care, if you love the CEO. I don't care if you know the people. I don't care what the reason is. If it doesn't, if the fundamentals aren't there, you should not be buying a stock. And with fundamentals, that means you need to understand the valuation and you need to focus on those numbers. You need to understand what that company is worth. You need to understand what you think is a reasonable price for that company and what the long-term, value of that company could be. You need to avoid the gambler's fallacy, which, because over a long enough timeline, all things approach the expected value. The gambler's fallacy is also called the Monte Carlo fallacy. And essentially what this is where, say you are betting on the flipping of a coin, right? We can agree that if it's a fair weighted coin, then that means each time that you flip the coin, there is a 50% chance of heads and a 50% chance of tails. If we agree that it is a 50% expected value of that coin flipping either of those, then let's say the coin is flipped twice and it lands on heads both times. The gambler's fallacy would be where you say that there is an increased likelihood that it is going to land on either heads or tails because there is no change. The underlying probability is still the same. The previous examples do not change what the theoretical probability of an outcome, of a fair outcome, is. Something to keep in mind. And the reason I say this is because this is the situation that we see where, people see, oh, a stock went down. Oh, it has to go up, so I must buy it. And then it doesn't. And then they keep doing this and not paying attention to the fundamentals. This is gambler's fallacy. And it also works in the inverse direction. And then for the removing emotion, you need to remember that short-term moves don't matter. Again, long-term, the stock market goes up. If you're betting on short-term moves, you're gambling, generally speaking. Nobody can accurately predict short-term moves in the market. We have to make sure that we remember that and that we're long-term investing for the average person. Rule number 3, avoid margin. Don't do it. Generally speaking, investing in stocks with debt is a horrible idea. For most people. Some people can do it. Some people really like margin, but most of the people that I've heard talk about margin tend to work for the investment firms, and they're trying to get people to, pay for their services. So it's not my thing. And even Kevin from Shark Tank on Graham Stephan's channel the other day was saying that, yeah, you should never use margin. It's a terrible idea. It hurts more people than it helps. So keep that in mind. And then 4, if you wouldn't hold it, this is from Warren Buffett, if you wouldn't hold it for 10 years, you shouldn't hold it for 10 minutes. It's a rule of thumb. If you're buying a stock and you're nervous about holding that stock for, a day, a week, a month, whatever, you shouldn't buy it. I mean, generally speaking, you should be buying stocks that you think are going to be around for 10 years or more. And if not, then you're adding more stress to your life than you probably need for 98% of people. 5, is there is no such thing as an easy or guaranteed amount of money, right? If something seems too good to be true, it is. If someone is selling a course on day trading, then I'm just saying they probably aren't making much day trading. There's a reason they're looking for that other, income stream. And pretty often this seems to be the case. A good example, if you want some entertaining looks at this, is CoffeeZilla. He does a great job of pointing these out. And then anytime you hear about something that's that's promising over 10% annually, pretty much, if it's guaranteeing that, it's a scam. Like it just is. That's not like there's the S&P 500 index is the best for the average person at 8% per year. If someone's, and that carries risk. If someone's guaranteeing you that or more, it's probably not real. You need to be skeptical of that and understand what is an expected outcome when you invest. Number 6, be consistent. If you lose money, do not revenge trade. This is the part of the gambler's fallacy. If you lost, you lost. The odds don't change because you're upset. It doesn't matter, right? And avoid making exceptions to how you evaluate an investment, i.e., my rules, as an example, are I only buy stocks on red. I don't care how good of a deal a stock is. If it's on green that day, I don't buy it. This is not because it's not necessarily a good deal if it's under my, valuation for it, but it builds a good mental habit where I don't end up chasing stuff. And then I also only buy stuff with low P's as a general rule. I will sometimes buy something that isn't, but as an example, this is why I wouldn't be buying Amazon right now, because the P is too high. I don't care how good the company is. It's overvalued in my opinion, currently. Rule number 7, be humble. The stock market is a competitive environment with, algorithms and millions of people who have more money, more knowledge, and teams of people, right, that are working to compete against you. Thinking that you know more than these people is generally a pretty big mistake, okay? Well, you got to keep in mind that the stock market is essentially like an open basketball court, but LeBron and Kobe and anyone that, is able to walk up. If you think that, if you like your odds in that scenario, then that's basically what you're doing. You're not going to be able, if you think you have the scoop on something because you read about it on Reddit or wherever, you might want to think about that one again. That's you're dangerously close to Dunning-Kruger. So that being said, every now and then you can find some good, info, but fundamentals is what I prefer. And then rule number 8, my last one for this, is valuation is what matters, not price. And this is a take on the Buffett quote of price is what you pay, value is what you get. If you think a company is worth a certain value, then if it's under that amount within your margin of error, then you should be buying it. If that price goes down and you're holding, in my view, is you buy more of it. You don't sell it because as long as you agree that it has not changed fundamentally what its value is, you should be buying if it's undervalued. It's the same as when you go and buy stuff on sale at a store. If it's under the price that it's worth, I'm going to buy it. I'm getting a sale. That's the way that I generally want to think about stock market and gambling, and make sure that we avoid these pitfalls as, retail investors especially. If you enjoyed this clip, be sure to leave a like, subscribe, and check out the full live version of the Wealth for 99 podcast, where we talk finance, economics, and public policy from a working class perspective. We'll see you there.